Right. I have, 30 minutes to fill, and I thought, geez, I don't know 30 minutes worth of anything. So I got to, but I thought I'd start out with the favorable seasonality period that we're just beginning. It's a 6 months period of favorable seasonality that was first mentioned by Yale Hirsch of Stock Traders Almanac years ago. But the negative seasonality begins on May 1st and ends on October 31st. And for an example of what can happen, I'll just take the last 12-month period. You can see this, the unfavorable portion. We actually did get a decline below. That line is drawn from the close on April 30th. So, and we did get a move below that, but it bounced right near the end. So for the period, even though unfavorable, it was up 3.6%. Yeah. Now the favorable portion, we started that out in a terrible mess, second half of the bear market, but after end of December, it's just been climbing, and we had an 8.8% gain in the favorable period, even though it started out terrible. The most important thing to take away from I think is that the seasonality is a drag or lift on the market, but you still have to deal with your basic trends and support levels, etc. We basically in the middle of this year put a cyclical bear market, and it affected both. But the secular bull market, which began in 2009, is still dominating the market. And even though we had that short cyclical bear market, it bounced back, and it's still rising.
Mm-hmm.
Let's try the next. We're going to talk about earnings. This is a chart that basically gives technicians a way to identify with the earnings picture. The bands that I have on there, the red, blue, and green. Red is overvalue based on a PE of 20. Blue, you moved
I lost it. Hang on. Sorry about that.
Yeah. The blue is fair value, and the green is undervalue. So we haven't actually been undervalued since, at the green line since 1984. And right now we're well above that red line at a PE of 22.24. If you look at forward earnings, and that's what the hash marks are at the right side of the chart, they show us where we will be, presumably on projected earnings, at the end of this year. So we are still within the range based on forward earnings, but we're still overvalued by any measure. And this is important just to know. It's like seasonality. When it's overvalued, you really have a drag on the market, but it doesn't mean you really can't trade off of this necessarily. It's just one of the things you plug into your knowledge base and help you make your decisions. Let's try the next chart of earnings. this is the long-term chart. And you can see from the left side, moving right, how the price has stayed within, pretty much within the bands, of the value bands. But then you see 1984 was the last time we saw that. And since then, it's been pushing towards the top end of the range, even outside. Any questions on that? Okay,
I'm not seeing anything just yet.
Okay, let's move along. We're going to go into volume ratios. A book I read a long time ago, Winning on Wall Street by Marty Zweig. And one of the things he covers in there is volume ratios. It's dividing up volume by down volume. And it's generally pretty uninteresting. And this shows the kind of a normal range. And but the 9, a ratio of 9 for up divided by down is normal. That's the when it gets into excess, and that's when you pay attention. I also showed down volume divided by up volume, and that's not really, as I recall, that was something that I've decided to do because I don't think he thought much of it in his book, but I just thought it's something I would like to watch. Okay, this is what kind of looks like normally. So go to the next chart. Okay, this is the kind of craziness you can get with the S&P 500 volume. Notice that in December we had a ratio of 480 up to down volume, and back in early 2018 we had a 370 ratio of down to up volume. The problem is that S&P 500 stocks are kind of homogeneous, and they're all large cap, and they tend to be traded heavily. And when they go one way or the other, they tend to all jump on board, especially when you have these climactic moves like we had in December. Notice, look at the small amount of down volume in that readout there. It's just 5.66 to 2,714. So
quite the difference.
Right, and it did. That one particularly came at a really opportune time. It really signaled the beginning of this up move. But if you look at the one in early 2018, that was kind of in the middle of the down move. We had, the high down to up fit ratio in February 2018. Mm-hmm. And it really hit in the middle of the move. So it's kind of a continuation indication when you get the down. Well, let's take a look at the next chart, and we'll get another. Yeah. Now you notice that we have we had the down move in 2008. We had a very high, it's like 1,500 down to up ratio. That came, again, it came in the middle-ish of the bear market. And it was well ahead of the final bottom. So it's kind of make you wake up, start looking for a bottom, but it's not likely to happen anytime quickly. Notice again, we have the one in 2010, it actually did give us a climactic bottom indication. So let's try the next chart. And basically, this is the NYSE volume, and this is kind of normal. This is probably what if you find this an interesting indicator, what you ought to be looking at. Still, the 9-to-1 ratio that he speaks about in his book, that's from the old days. I don't think you either get, you'll notice on this, you get sometimes approaching 9, but when it really gets above 9, it really gets way higher than that.
Yep.
And notice, and one of the things he talks about is kind of the, not back-to-backness, but yeah, back very close together, high spikes in that up to down volume. And we got the really bottom signal in December, and then in January we got another reinforcement of that move, and it's sort of something that you could bank on, so to speak. And the question is, where was I with this at that time? Well, it's like you look at this and you see, well, you just forget to look at it. So, I hadn't looked at it for basically years. And then I started digging around and I noticed this at one point, and I thought, well, this is something worthwhile. Which just, when you're getting large down moves or large up moves, this is something that can help you find the bottom or the beginning of the next up move. So you don't have to look at it every day, but when you're getting a lot of high volatility and down movement, and like we had at the December, January, there was really a mess, but this helped to clarify it, I think.
Yeah, this is interesting. I haven't seen these charts in forever either. And
right, yeah, it's just one of those things. Well, you don't look at them because they're boring day after day because nothing happens.
Well, we have so many to look at, I think, is the problem too. But yes, it's nice to find something that could have actually been a pretty good predictor.
Right. And this is right out of the book, that those high readings back to back.
Mm-hmm. All righty. We do have some questions coming in. Some of them are on the earnings chart. Would you like to do that now, or you want to wait till the end?
Let's do that.
Okay. So let's see. How much would the market value be at the center of the green line is one of the ones. Let's see. That makes sense.
Okay. How much? I'm not sure I understand the question.
So how much market value would be be at the center green line? So I'm guessing, we haven't gotten down there for quite some time, and I know we're marking it as undervalued.
Well, it's a PE of 10. That's where the market would be,
mm-hmm.
If it had a PE of 10.
Right. So that's really what the green line level is.
Right.
For those who are asking. They want to know how they can get this chart, and I will tell you that I will have a link to it in the Market Watchers live recap, and that way you can get that. Let's see, the other question. Oh, the source of your data, which I think is on here somewhere. Actually, no.
The source is it's the S&P website, Standard & Poor's website. I have an article up on this, and I should probably put that on the chart because I don't have a way to annotate as I would with an article.
Mm-hmm.
But it's from S&P. You can download a spreadsheet from their website showing the earnings. They published, last one they published was on the 24th, or as of the 24th of April. And so you get to watch the earnings as they're coming in and how the estimates change, et cetera.
Mm-hmm. All right. The last question I'm seeing in here, if interest rates are going higher, at what level would bonds begin to gain an advantage over stocks? It's
out of my area of expertise.
Yeah, I know, Tom, you talk about that quite a bit.
I'm sorry, what was that, Aaron?
Oh, I'm sorry. When interest rates are going higher, what level would bonds begin to gain an advantage over stocks? I think we talk about that a lot as far as interest rates moving higher.
Yeah, I mean, as far as the bond movement, I like to see money rotating out of treasuries, out of bonds, and into equities. You can have money flowing into both at the same time, and that's really what we saw when you look back to 1980. Because the argument that I always use is if the yields going down, that means money's rotating into treasuries and bonds, and that typically would be bad for the stock market. But if you look at since 1980, those yields have been dropping for 40 years, and the S&P 500 continues to move higher. So it's more of a short-term correlation or inverse correlation, depending on what you're looking at. But I always find it bullish when interest rates are going up. As long as interest rates are low, I find it bullish when they're going higher, because that normally is just telling us that the bond market is anticipating economic strength. Normally, you would get out of bonds and move into stocks if that were the case. So I like to see the yield going up in the short term. And I think even back in the 1960s, when we had a similar situation to what we have now with very, very low interest rates, it wasn't until the late 1960s when interest rates got up to about 5.5% to 6% on the 10-year treasury yield. That was kind of the tipping point for stocks. When you get rates up too high, and especially if rates are going up to combat inflation, that can be a negative. But otherwise, I think from the levels they're at right now, so long as we don't have an inflationary problem, I always look at rates moving higher as a short-term benefit to equities, because that money is then rotating away from the treasuries and bonds in general and moving into equity. So that's the way I view it.
Of course, the last 10 years has been, an abomination as far as fixed income.
Yeah.
And we've had, we had the QE, which kind of distorted some things there for a while as well. I mean, the Fed's trying to get back on track, but that clearly affected the relationship in the short term for a period of time.
All right. That's it for the questions so far. So I think we were in this chart.
Okay, we're ready to move, let's say, to the accumulation distribution chart.
There we go.
The last time I was on, Tom asked me to do a study on the difference between on-balance volume and accumulation distribution. I've covered this briefly on our Friday show, but I owe it to Tom to bring it back here and lay it on him.
Lay it on me.
The thing, if you look at how they're calculated, on-balance volume is just all the volume for the day. It goes plus or minus depending on how the price index closes up or down. Whereas accumulation distribution, it basically examines the price range for the day, and if the price closes in the upper half of the range, it's a plus to the cumulative volume you're keeping, and it's a minus that closes in the bottom half of the range. This would seem to, you'd think of accumulation distribution as being a scalper and OBV as being a meat cleaver. But this, I think, if you look at what the actual results are in this Apple chart, notice that we had in November through January of 2017 and 18, we had a rising tops on price, and we had confirmation on accumulation distribution, whereas OBV gave us a warning with a negative divergence. So confirmations are absolutely of very little value. I mean, they just tell you things are in gear, but it doesn't really guarantee, as you look here, accumulation distribution confirmed, but you got a price pullback, which the OBV warned you of. Moving to the right, we have a price bottom in April and a lower bottom in May of 2018. And notice that we have a positive divergence on OBV, but again, accumulation distribution just simply confirmed the lower price bottom, and OBV called it. Then again, we have we have a rising tops on price in May and June, and negative divergence OBV, confirmation on accumulation distribution. Finally, the big top in September, October, we have a divergence, non-confirmation on OBV. We actually got a divergence on the accumulation distribution as well. Finally, we have both indicators, excuse me, both indicators at the end of 2018 giving us a positive divergence and against the lower low of price. So, again, I think apparently certainly in this example, OBV is superior to accumulation distribution, in spite of the fact that it would seem to be less precise. So our next price, boy, I'm running out of time.
I know, see, everybody thinks that they're not going to fill the time, and they always do.
This is something I tried to cover in our Friday show last week, and talking about identifying climaxes. Initiation and exhaustion climaxes, they both tell you a story if you know what they are. And mainly, I think that the important aspect of identifying climax is to start out with a large price move on the day, and then have climactic readings on the indicators below it. So if you look at that, what we had in October of 2018, we had a very hard, a little higher, please. Let me see. Yeah, the price finally broke after we hit the big top in September, October. It finally broke, and it's basically setting a new trend. And so it was an initiation climax, and you can see that we had also climactic readings on net breadth, net volume. New lows were not there yet because it was a brand new move. We have the same, it's kind of issue in the end of October. We have another large price move, and we have accompanying spikes on the indicators. And the really big ones were right in December. We had an exhaustion climax. We had, you could have looked at the down moves from beginning of December into final bottom. I mean, those were all you could identify as exhaustion climax, except that it was never exhausted until that final bottom. But it's just, you get ready, you get ready to see where the final one is. And what we've basically discovered, I think, that the final exhaustion climax was in when the initiation climax came and that big up move on the 26th of December. And you notice the spikes in net volume, net breadth. And also we have notice on that exhaustion climax, huge, huge volume there. Now, on the in March, we have a nice upmove. It's not really a big move, so it's kind of okay. You're getting an initiation climax, but it's the fact that the price move is not that big. I just think it's a short-term indication, and then shortly after it, we get another. We get another climax, but it's an exhaustion climax. It spikes up. We have spikes in net breadth, and there's a little bit of that's not the volume's not much of an issue there. You notice the volume in March, about the middle of March, that big spike. That. Okay, that happens to be option expiration in the quarter option expiration, which is when you see large volume on that, that's the only thing you can attribute it to is to the options expiration. There may be something else going on, but that's going to just completely camouflage anything else. If we go a little to most recently, you look at last week, you see there was a nice up move, which I would call an exhaustion climax. But you see it had very little effect. I mean, we get a tiny little pullback and not much going on there. So mainly when you're worried about exhaustion or initiation, look at the size of the move to begin with. And I think I've just used up all my time.
Yes. Like, oh my gosh, and you're ending like right on the mark here. So I think we covered most of the questions in the room. Tom, did you have anything you wanted to add here?
Well, the one thing I maybe would add, going back to the seasonality at the very beginning, Carl.
Yes.
I actually wrote in my blog article this morning about the go away in May theory. And first of all, I completely agree that May through October, I think history has proven May through October clearly underperforms November through April.
Right.
I think anybody that goes back and looks at that history would come away with that conclusion. But for me, it's more about, and I just, because you've got that, little, go away in May just has that ring to it. I figured I'd come up with one myself. So I always say it's time to fly in mid-July. Because to me, May and June, and May, by the way, there's only 4 months of the year that since 1971 have outperformed May on the NASDAQ. I mean, if we go back almost 5 decades, April, January, November, and December are the only 4 months that are better than May for NASDAQ stocks. And June is not a particularly bad month, and the first half of July is not bad. But what I've seen going back, and I've done a lot of study on history myself, is that July 17th, for whatever reason, when we get to that earnings season, when we start into the earnings season, we usually have our typical run up into July. And then from July 17th through about the end of September 27th, that's where historically I think that there's a lot of evidence that suggests that we potentially we have a much better odds of the market pulling back over the summertime. And I think that kind of coincides with market participants taking vacation, and just lesser volume, maybe a little bit more manipulation in the market. So I guess one of my questions is, I know that, you're a believer of the May through October, but I didn't know if you had any other thoughts about the months of May and June and whether maybe going away in July might be a better time frame. Did you have any thoughts on that?
On the old Decision Point website, I had a series of charts going back, 1 year charts going back into the 1920s. showing the seasonality break, in the middle of the year, and it seems as if every year is going to be different. So I think the best you could be is prepared for some negativity if it comes. I mean, it's more liable to come in this particular time period, the next 6 months. But it's really not something that I'd ever do a trading model to put my money in at the beginning of the favorable and take it out at the end.
Mm-hmm.
Kind of thing. It's just that you just have to look at what the trend is and what the market's doing. Mm-hmm. It's like my timing models. They're not action models. They're information flags, and you just, okay, something's happening. Let's take a look. Let's keep an eye out.
Yeah, and I think too, I've gone back to since 1950 on the S&P 500, and I think over the last 69 years, May's gone up 41 times and down 28. So there's a little bit more of a bias that it's going to go higher than lower. But May has gone up the last 7 years in a row on the S&P. So it could be the odds are beginning to get stacked maybe against the S&P, that eventually one of these Mays we're going to move lower. And I don't think anybody would argue after the run we've had so far in 2019, if we had a pullback in May, I don't think that would be an earth-shattering development. I think everybody's kind of watching and waiting for a pullback. Any thoughts about this year being any different based on the fact that we've already run so much heading into May?
Yeah, I've certainly been looking for a pullback for a long time.
Yeah.
One of the things that I ran through my head when I was preparing this chart was, there's lies, damn lies, and statistics. And then I thought of another, so there's statistics, and then there's reality. So we know things are working against us in this, generally in this unfavorable period. But, other than that, just keep your eyes open and do your regular stuff.
Yeah, and I think too, you get anybody who tells you what they have done, you go to these mutual funds and all, and they show you their past history. They always have the disclaimer that past performance does not guarantee any future results. And I think you're right. Statistics, seasonality, all of that, I think we could put that caveat in there for sure, because nobody knows what the market's going to do this May. Nobody's going to knows what it's going to do for the next 6 months. But what we do have is a history that shows us tendencies that I think it's good to be aware of them, at least to know that if the market pulls back in the summer, that's not the end of the world, because that's been the tendency for the market to do, to pull back and maybe not perform as well over the summer. So I think it's good to have the knowledge, but I agree with you. I don't think it's a trading philosophy or a strategy.
All right. Well, there's the poll. We haven't talked about that just yet. Yeah.
Any surprises?
So the majority thinks that the market will be up in spite of the seasonality.
Yes. Yeah. And I have to say, I did vote up. What did you? I know what you're voting. Probably down.
I voted down, of course.
I'll break the tie. I went up.
Yeah, well, that's not a surprise, Tom.
That's not a shock. I do think this summer, I think we could have some consolidation, though. I don't think it's going to be. I'm not ruling out the possibility of it being straight up, because I think there are a lot of signs that are pointing to continuing movement to the upside. But I just think it would be much better for the market to sideways consolidate and base for a while. And it just doesn't seem to have any signs of that at this point.
Well, look at that seasonality chart if we've got time again.
I will get that back up here.
There you go. Notice in the last month how narrow the range is. It's been moving up, but in the process of it, it's a very narrow channel, which to me is indicative that it's melt up, or I wouldn't say melt down, but I think that we got to break out of that, and I don't think it's going to be the upside. But the melt up people would disagree with that.
Yeah, and I know too, when the volatility index shrinks the way it has, the market tends to get more boring to the upside when the volatility is down, in the lower teens or starts moving below the teens. So, but I agree. I mean, something's going to happen. We're going to have a little bit of a shakeout to the downside. I mean, we haven't even had a 20-day test here on the S&P for a little while. So that would be a minimum pullback, I would suspect.
Yeah.
Yep, and I set up because look at this period we started with that bear market. We still ended up on the upside at the end of that period, so that's kind of what I'm thinking. I'm not thinking we're going to have another straight up like we see in a favorable period. Just wanted to caveat that just a wee bit. Yep. And everybody is asking how they can get those charts. They are in the up volume, total volume ratios, those charts. You can get those from the Decision Point Market Indicators chart pack. And that's a free download if you are an extra member or above, because there are tons of chart lists in there. And basic members, you only get one chart list. So that's the only reason it's not available to you. But for everybody extra and above, you can get them for free.
And I do have to say, Carl, the homework that you completed and brought back to Market Watchers Live today was that was worthy of an A+.
Hey, thank you.
We always love to have you on the show, and we look forward to having you back again soon.
Thanks.
Appreciate it.